So moving on, we've heard a lot about accessing retirement assets, and we've heard the words qualified hurricane distribution. So can you tell us what that means?
Well, there's two provisions here to keep in mind. The first one is whether you're taking a loan or whether you're actually going to take a distribution. I'll talk about the loans first, because loans, for the most part, if it's not your personal IRA and you're taking money from a 401k or a qualified company plan, it's usually very difficult to enact the loan provisions, but IRS has lifted those completely. So if someone really needs to take a loan and they don't want to take a distribution, they're able to take a loan, pay themselves back over time, and the availability to do that is very much eased for them. That's a loan. If they take a distribution from the inactive date of the disaster up through December 31st of 2017, two things have happened. There's no 10% penalty if they don't meet the age limit. There's normally a 59.5 or disabled provision to not have penalty.
Okay.
So there's income tax and penalty for most distributions from retirement that's done prematurely. But IRS has looked at that during this disaster relief to allow for distributions that would be taxable income to be taken into income without the penalty provisions. The other key thing to remember here for that is that depending on the amount taken, if a distribution is wanted by the taxpayer, they're allowed to pick it all up in income in 2017, or they could elect to spread it over 3 years, 2017, 2018, and 2019. They're allowed to spread. If they took 120,000, they could pick it all up in 2017, or they could elect to pick up 40,000 each of the 3 years.
Because it's counted as income, they'll be taxed on it, so they can spread out that
Correct,
taxable
without
income.
penalty.
Without penalty. Okay, well that's a huge help, especially for those who are wanting to take distributions when they're trying to recover, whether it be their home or business.